Early buyers will make millions, and I am going to prove that statement with numbers you can pull from an SEC filing right now. Because while everyone is staring at chip stocks that already ran 300%, two companies are sitting quietly in the market with triple-digit earnings growth, record revenue, and stock prices that have not moved anywhere near what the fundamentals justify. Not because the businesses are struggling, the businesses are exploding. The stock is simply waiting for the rest of the market to stop chasing what already ran and start looking at what is still on the launchpad. That is exactly what today's video is about. I spent weeks going through earnings reports, SEC filings, and analyst research to build this case. By the end of this video, you are going to understand two stocks that I personally believe offer some of the most compelling risk-reward profiles available in this market right now. And you are going to understand them from the numbers up, not from a headline. If you want real analysis built on real numbers, hit that subscribe button right now. This is exactly the research that separates the investors who get rich from the ones who watch from the sidelines. Here is what we are covering. The fintech company that just posted its 18th consecutive quarter meeting the Rule of 40 grew revenue 43%, doubled net income, and is still trading 41% below where it was at the start of the year. And the energy drink company that controls 21% of the entire American energy drink market beat earnings by 41% and has analysts projecting price targets as high as $85. Let's get into it. Stock number 1. SoFi Technologies, ticker SoFi, current price around $14. Most people hear SoFi and immediately think of a flashy fintech startup burning cash. That narrative is not just outdated, it is the opposite of what the actual numbers show right now. Here is the reframe. SoFi is not a startup anymore. It is a fully licensed bank with 14.7 million members, 22.2 million products, and $1.1 billion in quarterly revenue that just posted its 18th consecutive quarter of the Rule of 40. Let me explain what the Rule of 40 means, because this is the metric that separates serious growth companies from hype. The Rule of 40 says that a healthy technology company's revenue growth rate plus its EBITDA margin should equal at least 40. If you are growing revenue at 40% and generating zero profit margin, you score 40. If you are growing at 30% and have 10% margins, you also score 40. SoFi just scored 72. 41% revenue growth plus 31% EBITDA margin. That is not the score of a company hoping to figure out its business model. That is the score of a business that has already figured it out and is compounding. Now let me walk you through the Q1 2026 numbers because they are extraordinary. GAAP net revenue totaled $1.1 billion, up 43% year over year. Adjusted net revenue was $1.087 billion, exceeding analyst estimates by 4%. Net income more than doubled to $166.7 million. Diluted earnings per share came in at 12 cents, up from 6 cents a year ago. Adjusted EBITDA reached $340 million, a 62% increase year over year. SoFi added a record 1.1 million new members in the first quarter, bringing total members to 14.7 million, a 35% increase year over year. Total products grew 39% to 22.2 million. And here is the loan origination number that tells you this is a real bank generating real economic activity. A record $12.2 billion in loans were originated during the quarter, reflecting a 68% jump compared with the same period last year. Personal loan originations totaled a record $8.3 billion, up 51%. Student loan originations hit $2.6 billion, up 119%. Home loan originations reached $1.2 billion, up 137%. Every single loan category is accelerating, not decelerating, accelerating. And here is the part that most investors are completely missing. Despite strong Q1 results with net income growth of 135% and record loan and deposit balances, SoFi's stock is still showing a 41.7% year-to-date decline. Net income up 135%. Stock down 41%. That gap is the opportunity. SoFi also announced the acquisition of UK fintech Primary Bids assets to bolster retail access to capital markets, expanding into international markets while its core US business continues to accelerate. Here is my honest concern. SoFi's stock fell 9% in pre-market trading even after beating revenue estimates. That tells you investor sentiment is still cautious. The lending business can be affected by interest rate changes, and the technology platform segment has shown some inconsistency. My takeaway: 18th consecutive Rule of 40 quarter, 135% net income growth, 43% revenue growth, 14.7 million members growing 35%, and the stock is still down 41% this year. The market is giving you a second chance at a business that is already winning. The early buyers who take advantage of that gap are the ones who will make serious money when the narrative catches up to the numbers. Stock number 2, Celsius Holdings, ticker CELH, current price around $30. Most people look at Celsius and see an energy drink company. They are dramatically underselling what Celsius has actually become. Here is the reframe. Celsius is not just an energy drink company. It is the fastest growing consumer brand in America right now, with 21% market share in the US ready-to-drink energy drink market. 2 brands, each generating over $1 billion in annualized sales, and distribution through PepsiCo reaching every major retailer in the country. Celsius Holdings reported record Q1 2026 revenue of $783 million, up 138% from Q1 2025. Net income was $85.1 million, up 147% from the prior year. Earnings per share of 41 cents exceeded analyst expectations of 29 cents by 41.38%. Think about what 41% above analyst expectations means. Analysts are paid professionals whose entire job is modeling these companies, and Celsius beat them by 41%. Not 4%, 41%. The combined portfolio of Celsius and Alani Nu reached roughly 20.9% share of the US ready-to-drink energy drink dollar market, giving Celsius 2 brands each generating over $1 billion in annualized sales. And here is the strategic position that most investors have not fully priced in. When Celsius acquired Alani Nu and Rockstar Energy, they did not just buy revenue. They built the second largest energy drink platform in America in terms of market share, behind only Monster. And they did it while maintaining their distribution relationship with PepsiCo, which reaches every corner of the American retail market. Analysts maintain a positive outlook, with price targets ranging from $40 to $85, reflecting varied perspectives on the company's growth trajectory. $40 to $85. With the stock sitting at 30, even the most conservative analyst target implies 33% upside. The optimistic target implies over 180% upside. Here is my honest concern. PepsiCo distributes 59% of Celsius revenue, creating real concentration risk. Gross margin was 48%, pressured by higher costs and competition. The acquisition integration creates execution risk, and the stock fell even after the earnings beat, showing that investor sentiment remains cautious. My takeaway: 21% market share in a category that has been growing for years, 138% revenue growth, 41% earnings beat, and analysts projecting targets as high as $85 on a $30 stock. For investors who believe the American consumer keeps buying energy drinks and Celsius keeps taking market share, the entry point here is one of the most compelling I have seen in consumer brands in years. Let me bring this all together. Two stocks, two completely different businesses, one unified thesis. The market right now is rewarding momentum at the expense of everything else. The stocks that ran 300% this year are getting all the attention, and the stocks where the fundamentals are building quarter after quarter are sitting at prices that do not reflect what the numbers are already saying. SoFi Technologies just posted its 18th consecutive Rule of 40 quarter with 135% net income growth, and the stock is down 41% this year. Celsius Holdings just beat earnings by 41%, controls 21% of the American energy drink market, and has analyst targets as high as $85 on a $30 stock. These are not speculative stories. These are real businesses with real earnings growing at real speed. The market has not caught up yet. That is the opportunity. Here is the investing truth I want to leave you with today. The biggest money in any market cycle is almost never made by buying what is already running hot. The biggest money is made by identifying strong fundamentals early, buying when sentiment is cautious, and holding while the market catches up to what the numbers are already saying. SoFi's numbers are saying the business has already turned the corner. Celsius's numbers are saying this brand is taking over its entire category. The market has not fully priced either of those realities yet. Early buyers will make millions. The evidence is in the filings. Disagree with either of these picks? Tell me in the comments. Which one would you buy first? Which one do you think I have wrong? Subscribe for weekly research on where the fundamentals are building before the narrative arrives. No sponsors, no fluff, just the analysis. See you in the next one.